Hello, this is Domenico Composto with the next part of a Paper 3 practice question. In the first part of this practice question, we looked at tickets at a stadium being sold and this concept of revenue maximization and the rule for revenue maximization occurring where the marginal revenue curve intersects the interceptor x-axis, or where MR equals 0. And that's essentially the midpoint across the demand curve, running from 0 to 160. In this case, the midpoint is 80. So the marginal revenue curve runs through that point. That sets the output at 80,000 tickets with a price of $500 in this case. So total revenue, price times quantity, we came up with 40 million. This will be linked in the video notes below. For those watching from a desktop, there'll be a link up in the top right corner as well. So in this video, we're going to go over the next part of the question for paper 3. We'll continue from our work. Here, we're going to highlight some key terms and then tackle question CA here. So you should be in the habit of reading a question, kind of highlighting or underlining some key terms as you go through so that you're focused on what the question is asking you. So here it says fixed costs for the match have been calculated at 12 million. Perfect. So we have fixed costs at 12 million. And there are no variable costs. So in the next video, we're going to talk about that and how that relates to the supply curve. How does that impact the marginal cost curve? Now let's look at the question. Calculate the average fixed costs per ticket if all tickets are sold at the revenue maximization level of output. So you're going to pause this video and try tackling this question here. Go ahead and calculate the average fixed cost at the revenue level of maximization with the information that you have here. Pause the video and we'll check your work in a moment. Please pause the video now. All right, let's see what you came up with. So there's some prior knowledge that we need here. First, there's another video that explains total costs, total variable costs, total fixed costs, and how we can use that information to calculate the average fixed costs. And so that question is asking us to calculate the average fixed cost, which is equal to total fixed costs divided by quantity. Just for review, total fixed costs are constant. So in this graph, graph A, that fixed cost might be rent. Maybe you're paying $100 of rent for a commercial space. And within that commercial space, it doesn't matter whether you produce 1 unit of output or 10,000 units of output. There's no impact on the fixed cost of rent. So it is constant regardless of the quantity of output. If you take a fixed number, total fixed cost, divide by an increasing quantity, then the average gets smaller and smaller and smaller. So we see the average fixed cost getting smaller and smaller and smaller. So in this Practice 3 video series, we will plug in data from this question and then plot that average fixed cost curve. But that's not for this video. That'll be for another video. All right, so let's go ahead and demonstrate our work. So average fixed costs is equal to total fixed costs divided by the quantity of output. So since the total fixed costs are 12 million, it says here, we're going to plug that in. So we have 12 million divided by the quantity of output at revenue maximization. Revenue maximization occurs where MR equals 0. Just for review again, revenue maximization. And there'll be links to videos below that explain that in greater detail. So MR hits 0, and that's the midpoint across the demand curve. So here we have 80,000 tickets. So I'll just plug in the quantity of 80,000, and then there we go. So the average fixed costs is equal to $150 per ticket. So $150 per ticket on average is the fixed costs of each of those tickets, which is what you have calculated. If you want to, This is going to help you with the next part of this question. You can plot 150 approximately right about here. There's $150 of costs on average regarding the fixed costs, but we'll save that for part B. So that's it. Look for the link to the next video. We'll tackle part B. And in the next video, we're going to talk about profit maximization and revenue maximization in the absence of variable costs. And then we'll lead to answering this part B question. If you have any questions, feel free to comment those questions below, and don't forget to subscribe and to like. Thank you so much.